Good evening, everyone. How are we? Hello, how are we all doing? Welcome back, welcome back. Again, just give me a little thumbs up just to make sure you can hear me. Fantastic. How are we all doing? So again, we'll just give it a few minutes and then we'll get going, let everybody join. But today we are getting into some of the good stuff, some of the exciting stuff, some of the tangible things that you can go and take away and implement yourself. So lots of exciting things to go over. Let me just check the Telegram. Slowly but surely people are joining. Right, we'll give it a... Oh, there we go, more people. Again, we'll give it to about 5 past and then we'll get going. Today's lesson, I'm quite literally going to blow the lid off of everyone else in this whole industry. Anybody else that thinks that they can deceive people and get people to pay for shitty services in this industry, this video is about to eradicate everything. If you're watching this and you watch this video, you'll know quite literally the exact way in which you can start trading. You don't need to go and pay anybody or sign up with anybody's stupid signal service or anything like that to find out how to trade. In this lesson, you're going to learn all the tools you need. You're going to learn exactly how you can go and find some trades, and you're actually going to have some tangible knowledge that you can go away and use. So again, when you get approached by these people telling you to join them and follow their signals, you can say, nope, I watched lesson 2 of Pip Camp. I know what I need to be doing in order to succeed in this industry. And following your signals is certainly not that. Again, this is really why I wanted to do this, why I wanted to launch the new company WeTrade in this way, just so that there was no shadow of any doubt of how the most optimal way and how people should be getting started in this industry is. We're going to build a nice foundation of knowledge today, and then next week I'm going to show you how you make money in this industry and how you can make a lot of money in this industry. And it certainly isn't by putting £300 into a trading account and following someone's signals. Again, I'm going to keep repeating that because again, I want to ingrain this into people's heads. Following signals is probably the worst way of doing things in this industry right now. Again, I touched on it a little bit yesterday, but the opportunity to make money in trading right now with the way that the market has developed and the way the industry has developed over the last few years is, again, it's second to none. It is second to none. And with the right skills, which we're going to build on, we're going to build the foundation of today, you have a very long and prosperous career in this industry ahead of you. Again, obviously, if this is something that sparks your interest and you're interested in doing this type of thing. All right, so it looks like we've slowed down a little bit on the people joining. So, without further ado, so I'm going to be playing that at the start of every single lesson just because I really enjoy listening to that. I hope you do as well. But in today's lesson, oh, where's my camera gone? Let's just move over then. Bit of a technical glitch. What's going on here then? Oh, right. Let's just get straight into this then. So in today's lesson, we're going to be having a look at how you can assemble your battleship. Again, very ominous sounding, but I just wanted to make it sound cooler than what perhaps it is. But in today's lesson, we're going to have some real tangible knowledge. You're going to have some real tangible things that you can take away and you can sort of build that base knowledge. So everything that you learn from here on, you know exactly how to execute and where to execute it. So before we get into today's lesson, let's have a quick recap on last night's session, just to jog your minds just a little bit. So yesterday we briefly touched on how we're currently living in a market. We're living in a country, we're living in a world where we are essentially forced to trade our time for money. We're conditioned throughout school and just in the general social construct of today's society. We're built in a way where we have to exchange our time for money. And the more time you have, statistically, the less money you have. And the more money you have, the less time you have. So even if you want to make more money, you have to trade that directly for your time. We then had to look at why I believe the trading business model, or the model of how you make money with trading, is far superior to other business models like e-commerce and dropshipping and Amazon FBA, because you do not have to deal with the end consumer. It's simply you in the markets and you're able to make money. And then we had a look at the very sort of stereotypical trader's lifestyle, but when you actually boil it down, how some of the most successful traders do in fact have a lifestyle of freedom and with a nice strict routine, which we're going to be touching on later on in today's lesson. You can extract a good living amount of money out of a very short period of time in the markets, giving you a lot of free time during your day to do the things that you love. So as we touched on already, in today's lesson we're going to be having a look at how you can assemble your battleship to essentially build that platform to become a successful trader. So if you're watching, either have another screen next to you or have a notepad, because there's going to be a lot of things for you to take down and take note of. But again, before we get into things, let's do just a little bit of housekeeping. Again, I'm just going to recap this because I don't want anybody to be missing out. Number one, make sure you've entered that giveaway. There's a link generator that has been emailed to you and is in the Telegram community. So make sure you've made your own link and you're sharing it with as many people as you can. Number two, of course, make sure you join the Telegram, because that's where you're going to get all the information on the event. That's where you're going to get the link for the Q&A session that we'll be running at the end of the event. And that is also where I'm going to be sharing all of the giveaway winners as well. And third and finally, I've decided that I'm going to give away a pair of AirPods for somebody on today's session. All you have to do is take a picture of the screen or any point during this session on your Instagram story. Make sure you tag at George Lymph and at wetrade.io. And then tomorrow, about the same time tomorrow, I'm going to go through, pick one person that has tagged me at random, and you're going to get a pair of AirPods completely free of charge. And we'll just ask for your address and we'll send you a pair of AirPods. Again, so just a little one-off giveaway that I thought I'd do for somebody that wants to give me a tag on Instagram. So then, let's get into today's session. Now, just again, a little bit of a briefing on how I started. Now, when I started, this whole luxury lifestyle was not really where I was sort of positioning myself. It wasn't really why I got into this. But the fact of the matter is, a lot of people do get drawn in and they focus on the luxury lifestyle aspect of not just trading, but really any side of online income. But like I said, that was not what I wanted. The sort of main driver for me when I started was the fact that I didn't want to get trapped in that 9-to-5 rat race. Throughout my whole sort of teenage life, when I was growing up, I was always somewhat entrepreneurial. I would do loads of things. I used to like design trainers. I would paint custom trainers. I would sell nipple tassels, for example, on eBay. I used to do all sorts of random things as a kid, just to sort of try and get out of that 9-to-5. But I always had my dad and my parents telling me to go and get a job, and I'd try and do anything that I possibly could to just not go and get a job. But again, I constantly was hounded. I was constantly hounded by them. Eventually, I did have to go and get a few jobs, but all of the jobs I'd got were 0-hour contracts, so I wasn't tied down because, quite frankly, from the get-go, I always valued my freedom more than anything. I was always called lazy by my mum and dad, but I don't think it was necessarily me being lazy. I feel like it was the fact that I just simply valued my freedom more than perhaps the money that I was earning in these small little jobs. Okay, of course I had the dreams of the Lambos, again, who doesn't, and these nice holidays, but that wasn't really the driving force that kept me going. It wasn't really the driving force that kept me going to make a success of myself. And now I literally only trade sort of 2 to 3 hours per day at that very, very most. Again, we've already touched on this before. Now, the goal of Pip Camp is to show you step by step how you can go from 0 to 10k per month as a trader. So if you are like me and you value your freedom more than potentially the money that a job can provide you, you'll have a clear step-by-step guide, a step-by-step roadmap of how you can essentially get into trading and you can scale from 0 to 10k per month to try and make this a reality. Now, I put this event together to pay homage to my 17-year-old self. This is actually me, and that's my little brother there. I think this must have been on my maybe 17th birthday. But I put this event together as an event that I would have wanted as that 17-year-old self. Okay, when I was lost and when I didn't really know what I wanted to do with myself, I would have loved an event like this to just give me that step-by-step roadmap, so I knew exactly what I needed to do in order to achieve that freedom that I wanted. So again, guys, in today's session, we're going to be having a look at assembling your Battleship. Now, as a trader, there is not a lot that we need in order to become very, very successful at what we do. With just a handful of things, we can make a hell of a lot of money in the markets. So really, there's 4 main things you need to master to become a successful trader. Okay, number 1, we need to build that armory. Okay, the tools you need to become a six-figure trader. Number 2, you need to know how to protect your money. Okay, how you can take control of your risk and limit your losses. Okay, because the last thing we want to be doing is losing money. Okay, so if we can focus on that to start with, and we can make sure that if we're losing, we're only losing very small, we're already one step ahead of the curve. Number 3, we need to be able to find winning trades. Okay, we need to know how to analyze, plan, and execute profitable trades. Okay, because if we can't do this, then this is pretty pointless, and we're not really going to get anywhere. Okay, we need to know how to make money. Okay, like anything, if you can't make money, then it's not going to be a sustainable way for you to transition from perhaps full-time work. Okay, so you need to build those skills in order for you to generate income. And then number 4, again, it's all well and good having all the knowledge in the world, but if you can't take action and apply the process, you're not going to get anywhere. So we need to build that winner's routine. So number 1, the armory. What tools do we need to become a 6-figure trader? And again, guys, if you have any questions during this slideshow and during this presentation at all, just stick it straight in the comment section. Again, this is going to be nice and interactive. So if there's something that you don't quite understand, if you've got any questions, fire them away and I'll be working through them live. Okay, so if there's anything you don't understand, make sure you do let me know. So the armory, like I said, we don't need many tools. We do not need many platforms to become a successful trader, but there's 3 very, very crucial platforms that, again, we just simply will not be able to live without. So number 1 is MetaTrader 5. So again, guys, if any of you have traded before, you'll know what MetaTrader is. But specifically, the one that we'll be using is MetaTrader 5. Now, there is MetaTrader 4, which is very, very popular. But for the majority of people, MetaTrader 5 is going to be where we're going to be placing our trades. Okay, now you have a mobile app and we also have a desktop version. In today's session, we're just going to be looking at the mobile app just to keep things nice and simple. And number 2 is tradingview.com. So again, make sure you write these things down because again, after the session, I would expect you to go away and start to use these. So we've got tradingview.com. Again, we have a website and we have a mobile app. This is again completely free to use. You can pay for upgrades, so just to make it a little bit more enjoyable and a little bit more useful if you're using this full time like I do. Again, I pretty much spend 99% of my time on this website. And this is where we do our analysis, okay? So this is where we look at the charts, we look at the markets, and where we actually find our trades, okay? So TradingView is essentially where we'll be spending the majority of our time as a trader. And number 3, I've put down Calculate here, which is actually an app that I built, but unfortunately, again, very sort of typical of running this. Calculate is actually off of the App Store at the moment, but again, we have alternatives we're going to go through in just a minute. And this is our risk management calculator. Okay, so this is the app that we're going to be using to make sure that when we're trading, we're keeping the risk small. Okay, so we're going to run through all of this very, very shortly. Okay, so again, I've got a question. Is there much difference between MetaTrader 4 and MetaTrader 5? So there's not really a great deal of difference. MetaTrader 5 is just the updated version. The reason that I use MetaTrader 5 is because MetaTrader 5 has an application that works on Mac. Okay, so I trade on Mac. You can't use MetaTrader 4 on Mac. There's a native app for MetaTrader 5 on Mac. So again, it's just way more efficient for me to use that. And of course, it's updated, so it runs a little bit more smoothly. So again, there's not really much difference, but it's just better if you're using a Mac. So then, let's start with number 1. Let's have a look at how we set up a MetaTrader 5 account. So, MetaTrader 5, again, you can just go on the App Store, you can download the app, get it downloaded, it's completely free to use, and all you'll need to do is open the app, and the first thing that you want to be doing is opening a demo account. So again, just to keep things super, super simple here. You want to open the app and go down to the settings section in the bottom right. We then want to be going to the new account section. So you'll see a menu come up and you'll be able to click new account. You'll then see MetaQuotes Software Corp dot come up. Again, you just want to click that, and then you want to click demo account. Okay, so it'll say register a new account, and you just want to click demo account. Okay, now a demo account is just an account that gives us fake money, paper money, so it allows us to just trade essentially simulated trades. Okay, so we're not risking any real money, but we're still going through the exact same process as we would if we were to be trading real money. Okay, so it gives us a safe platform to trade on whilst we're learning. Okay, so again, you just want to get this, demo account set up. It will then come up with a little screen like this. You'll just have to fill in your details. So again, name, mobile, email address. You stick that all in. It should pop up with the same details as I've got on here. So again, you shouldn't really have to change anything, but again, just make sure it's in GBP. Make sure your leverage is at 1 to 100, and make sure again your deposit. Again, it doesn't really matter. So again, just put it to £100,000 just to keep things simple. Again, you just need to accept the terms and conditions. Again, you're not signing up to anything here. This is completely free. You're not putting any details in, and then you just be able to click and register an account. Again, once that's done, you'll have the account and it will be there ready for you to trade. All we then need to do, again, just keeping this in mind, we'll go on this, touch on this in a little bit more detail in just a moment. But then all you need to do if you're looking to actually place a trade is you'll have, there'll be a little menu at the bottom and it will say quotes. You'll just have to click on the quotes thing, on the quotes button. You'll find the currency that you want to be trading. Okay, so say for example, we've done our analysis on Euro USD. We've said, okay, we want to be buying Euro USD. So we'll go on there, we'll find Euro USD, we'll click it, and then we'll press trade. This is when this screen here will pop up. And this is essentially where we put in all of the details of the trade. So we'll put the lot size. Again, we'll touch on this in just a minute, but the lot size is essentially the amount of money that we want to be putting into this trade. Okay, so it's not quite done on sort of, you wouldn't say I'll put in £10 on. We buy in lots, but again, we'll touch on that in just a moment on how to work all of that out. You'll then put in your stop loss. Okay, so your stop loss is essentially you telling your broker that if my trade gets to a certain amount of loss, or it gets to this certain loss, I want you to close that trade for me, and I'm happy just to take that loss and walk away from the trade. Okay, so it's essentially the safety net. The stop loss stops you from losing tons and tons of money. Okay, and we then have the take profit. So the take profit is essentially a level that you set where you say to the broker, okay, I'm happy to take my profit off the table here, bank my profits and walk away from the trade. Okay, so we put these in. So number one, we don't have to be sitting watching the markets all the time. And number two is a bit of a safety net. Okay. So again, it's that simple. Okay, that's all we need to know about MetaTrader 5. Okay, MetaTrader 5 is where we physically place the trades. Now, we're not going to be using MetaTrader 5 for anything other than actually placing our trades. Okay. Number two is tradingview.com. So this is where we're going to be doing the majority of our work and the majority of our analysis. Okay, so this is where we're actually going to be finding the trades. So we're going to go into this in a little bit more detail, later on in the session. Okay, but again, just note this down because this is essentially going to be the website you're going to be doing the majority of your work on. So you're going to go to tradingview.com. You'll be able to set up an account. And then you can just get onto the charts that look a little bit like this. Okay, so you'll be taken to the main website. You'll then be able to just go through and go onto the charts. Okay, so from here, you'll have all your tools up the left-hand side that help you do your analysis. You can see there, it says Euro GBP. That's where you find your currencies. So again, you can flick through the different currencies that you want to be looking at. And then you obviously have your candlesticks there, which is what we're going to be analyzing in order to try and find some trades. So again, that's TradingView done. Again, we'll touch on that in just a minute. And then third, and probably one of the most important things that you should prioritize learning as a beginner is your risk management. Okay, so we're going to be walking through how to actually manage your risk. Okay, so the third and most important thing is, I've put down Calculate here, but again, the one that we're going to be using isn't actually Calculate. So the risk management calculator we're going to be looking at here is called the Baby Pips Position Size Calculator. Again, so just note that down. This is the one. It's just a website. It'll open a little tab like this, and again, we just input our data into this, and it will essentially tell us what lot size we need to be using in order to risk the amount of money that we want to risk. So again, like I said, I have actually developed an app that's free, so you can just do this on your phone. At the moment, it's actually off the App Store because we're redeveloping it, but again, it will be up very, very soon. But again, that's not really too important right this second. So then, those are essentially the three tools that you need. Okay, so as long as you've got those three things set up and ready to go, you now have a platform that you can go and make money with. Okay. As long as you've got those three tools, that is all you need to not only make £1, not only make £10 or £100 or £1,000. This is all you need to be making £100,000, £1 million. Okay, these are the three things that I have used to make every single penny that I have ever made in trading. Okay, I've not got any fancy softwares, anything that costs me thousands of pounds. No crazy algorithms. Just three. Basically free softwares, and that's it. Okay, it's as simple as that. Okay, so now we know the tools and the platforms that we need. Now let's actually get into the sort of technical side and how to actually use some of these platforms. So again, we know what we need to be using. The second most important thing here is how to actually protect your money. Okay, how can you take control of your risk and actually limit your losses? Okay, so before we even look at the charts, the number one thing you need to be making sure that you're doing is managing your risk and stopping yourself from losing stupid amounts of money. Again, we can all agree we do not want to be losing money. Okay, the aim of the game here is to make money. Okay, so you can get one step ahead of the curve by stopping yourselves from losing lots of money. Okay, if you can limit your losses, when you maximize your gains, you can very quickly be putting yourselves into the positives. So, protecting your money. Rule number one, don't lose money. Okay, I mean, kind of. Okay, so losing money is actually part of the game when we're trading. Okay, we have to learn to actually love these small losses, but when we do make losses, we want to make sure that they're actually small. Okay, we want to be losing calculated amounts. Okay, in any trading plan, in any trading strategy, we're never going to be winning every single trade. Okay, but what we want to be focusing on is that long-term average. Okay, so we have to factor in some losses there. Okay, and rule number two is to keep risk low. Okay, one of the only things that we can truly control when trading is our risk. Okay, we can't control where the market's going to be going, but we can control to the absolute penny how much money we'll lose if the trade goes against us. Okay, and to keep our trading consistent, scalable, and manageable, we want to be only risking 1% per trade. Okay, 1% in most cases. Okay, again, you can get into some technical aspects where you might risk a little bit more or a little bit less, but to keep things simple, risking 1% per trade is typically where we want to be and what we want to be doing. Okay, we want to be keeping that downside calculated, and we want to be able to maximize our upside. Okay, the upside on a trade should be speculative. Okay, we can use something called risk to reward, which we'll touch on in just a minute, where we can maximize the upside of a trade, but if we don't keep that downside set and manageable and scalable and consistent, then it doesn't matter how many times we win, because we'll never be able to scale because we have no control over how much we're going to be losing. Okay, so we keep those losses at 1% every single time. Every single time we know we're only going to be losing 1%. Okay, and if we can make 2% on a trade, 3% on a trade, then as long as we win the same amount of trades as we lose, we'll be making money. Okay, and in some cases, we could even lose more trades, and as long as our wins are maybe if we risk 1% and we gain 3% on our wins, we'll be able to put ourselves in a position where we can actually end up losing more trades than we win, and we can still make money. Okay, but if we don't manage that risk and we don't keep that risk small and to 1% on every single trade, then that's just not going to be possible. So how do we do that? Okay, and it's actually very simple. Okay, we've got calculators that we can use where we just input the data from our trades, and it will tell us exactly what we need to do in order to keep that risk to 1%. So this is where the risk management calculator comes in handy. Okay, so again, let's just talk hypothetically here. We've done our analysis. We found a nice trade that we want to be taking. Okay, now what do we need to do? Well, we need to jump over to the risk management calculator. Number one, we need to set our currency. Okay, so if your currency is in USD, you'll leave it at USD. But if it's in, for example, GBP, you'll change it to Great British Pounds. Number two, we input our account balance. Okay, so if I'm trading with £1,000, for example, I'm going to put in £1,000. If I'm trading with £100,000, I'll put in £100,000. Okay, it's that simple. Number three, we want to be putting in our risk percentage. Okay, so again, for argument's sake, we're going to keep our risk to 1%. So what we do is we just put in 1% into this box. We then want to be putting in our stop loss size. Okay, so again, I'll touch on this later on in one of the later sections in the lesson. But in here, this is where we put our stop loss size. Okay, so our stop loss size is essentially how far from where we're entering are we going to be setting our stop loss. Okay, so this could be 5 pips, 10 pips, 20 pips. Okay, but we'll touch on this in a minute. So whatever that number is, that's what you want to be putting into this box here. And then finally, we want to be putting in the currency pair that we're trading. Okay, so again, if we found a trade on Euro USD, we'll put in Euro USD. If we found a trade on Euro Japanese yen, we'll put in Euro Japanese yen. Okay, and when you click this box, it will come out with loads of them. You can scroll through and find the pair that you're trading. Now, when we do this successfully and we put all the data in and we press calculate, what is going to happen is it's going to essentially give us a ton of numbers. Okay, so number one, it's going to tell us the amount of money that we're risking, and it's then going to give us a load of different lot sizes. Okay, it's going to give us a load of different lot sizes. The one that we want to be paying attention to is the one that says standard lots. Okay, because the accounts that we'll be trading on standard lots. Okay, so for example, in this instance, I'll put in that we're trading our account balances in pounds. Our account balance is £10,000. I want to be risking 1%. Okay, so £100. The size of my stop loss is 20 pips, and the currency pair that I'm trading is Euro USD. Okay, it's also popped up with another box here asking me the current price of GBP USD. So this is where you'll just have to go over to your trading view or to your MetaTrader, and you'll just have to find what the price of GBP USD is, and you have to put that in there. Okay, this is just another thing to help it calculate more accurately. But again, it's just very, very simple. You'll be able to find that. Then you press calculate. It's then told me that in order for me to risk 1%, when I enter this trade, I need to use the lot size 0.6789. Okay, if we were actually like trading and we put it into MetaTrader, you can only use 2 decimals. So again, we would just keep it to 0.67. I'd round it down because I'd rather under risk than over risk. So we'd put in 0.67. Okay, so you just put in the data into the calculator, and then it will tell you exactly what lot size you need to be using on MetaTrader. So just here, so like we have here, the number that I pointed out earlier that is the lot size, that is just simply the number that you put in there. Okay, so we take this 0.67, and when we go to enter the trade, that's the number that we put in this box here. Okay, we then put in our stop loss, we put in our take profit, and we'd be able to press buy or sell again, depending on what direction we want to be trading. And there we go, the trade would then execute. Now what this does is, this gives us full control over our risk. Okay, so even if we enter this trade, we think it's going to go really, really well, but unfortunately the market goes against us and we end up taking a loss. It hits our stop loss. We already know beforehand, worst case scenario, that this trade will only lose us 1% of our account balance. Okay, so we force ourselves to have full control over our risk. Okay, how many times have you heard people saying that, oh, trading is risky, investing is risky? Again, just give me a show of hands. Give me a thumbs up if you've heard that before. How many people say that trading is risky? I must get told it, well, when I was getting started, I got told it millions and millions of times. So many people would tell me that trading is risky and we're just going to be losing money. But again, the fact of the matter is, we can take full control over that risk. It doesn't have to be risky. It could be as risky or as safe as we want it to be. Okay, if I want to go and risk 50% of my account balance, then yes, I'd consider that risky. But if I trade just 1% risk, if I just wanted to trade 1% risk, then for me, I wouldn't class that as overly risky, because I would have to lose 100 trades in a row for me to lose all of my money. Okay, and even if you're the worst trader, losing 100 trades in a row is actually surprisingly difficult. So again, even if you just stick to this 1% risk rule, even if you're the worst trader in the world, you've got a considerably longer life than somebody that's not going to follow this very, very simple formula, this very, very simple method of managing your risk. Again, guys, this is very, 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 very important. Okay, if you can master this, you're already probably 100 steps ahead of 99% of people in the market. Okay, people don't want to teach you this, because either they make money off of you losing, or they just don't really care whether you lose your money or not. Okay, people are scared because this isn't pretty. This isn't good marketing. This is the truth. Okay, and again, I'm in the education business, so I'm here to help you guys make money. And if you don't do this, you won't make money. or you might make a bit of money, but it's going to be lucky. And within a few weeks, you're very likely the market's going to go the other way and you're going to lose it all again. Okay, so if you take only one thing away from me this evening, let it be this. Yes, this will be recorded and you're getting access to it. So far, we know what platforms we need to be using and we know how to protect our money. Number 3, let's get into some of the exciting stuff. Finding your first trades. Okay, we need to know how to analyze, plan, and execute profitable trades. Okay, if we don't know how to do this, then this is all useless and it's really not much use. Okay, we need to know how to make money. So, finding your first winning trades. How do we find winning trades? Now, in order to find winning trades, time and time again, you need to have a proven trading strategy. A trading strategy is a set of rules you follow each time you're at the charts doing your market analysis and looking to enter trades. Now, your rules will consist of what do you need to see to determine where I enter a trade? What do I need to see in order to execute a trade? And where am I going to exit my trade for a profit or for a loss? Okay, so these trading strategies, again, everybody has a different trading strategy. Tons of people have different trading strategies. But what separates people is how good their trading strategy is. Okay, some of the trading strategies I've seen over the years have just been god awful, but what's led myself and my community members to lead such a successful trading career is the fact that our strategy is not only simple, but it's very, very effective as well. So what I'm going to be doing now is I'm going to jump over to TradingView. Let's take a look. I'll have a little bit of an insight into the strategy and into the way that I like to trade. So, this is TradingView. Okay, so this is the platform that you'll be using to actually make your trades. Very, very sort of user friendly. You'll be able to get along with it quite well. Again, it'll just take a bit of time just of playing around and just using the tools. But very, very simply, on the left here we have all of our tools. Okay, all of the tools that we'll be using to analyze the markets and all of the things that we can use to draw on. Okay, so for example, we've got the things like trend lines that we can use, we can place on. We've got a load of tools here. Again, it all pops out. The majority of these we don't use. Okay, but we'll touch on one in a minute. We've got all of our drawing tools here. Again, tons of things here. Anything that you need to analyze the market is going to be down this left-hand side here. Across the top here, we've got the different time frames. Okay, so we have the daily time frame, for example. Now, the daily time frame is essentially every single candle that we have here represents 1 day's worth of movement. Okay, so this is 1 day, this is 1 day, this is 1 day. We have, for example, the 4-hour time frame. So every candle here represents 4 hours worth of movement, and so on and so forth. So we've got 1 hour, 30 minute, 15 minute, and so on and so forth. Again, today we're going to be doing the majority of our work on the 15-minute time frame. Okay, so just to take note of that, on the 15-minute time frame. Now, the problem that I see with people trading, okay, the majority of people, they use very, very simple retail methods such as trend lines. Okay, so if you've looked into trading, you've probably seen people talking about trend lines, for example. Okay, when the market comes to a trend line, you buy or sell. You'll also see people talking about, or the majority of people talking about, levels of support or resistance. Okay, now the problem that most people have with trading is if you do what most people do, you'll be losing money, because most people lose money in the markets. Okay, that's not an opinion, that's fact. Okay, 90% of people lose 90% of their money within 90 days because they follow stupid systems, stupid strategies like this. Okay, again, there's probably tons of you in here that have traded before, and you've had people talking about support and resistance and trend lines and stuff like that, and you've probably lost money and you've probably wondered why. And well, that's because 90% of the industry, or 99% of the industry, trade this way, and 99% of people lose money. Okay, now really the key to be making money, okay, the key to be making money in this industry is to be able to follow where the big players in the market are trading. Okay, where the big players are moving the market from and to. Okay, where the banks are moving, where the hedge funds are trading from. Okay, so instead of us doing what the masses are doing, we want to do what the big players in the markets are doing. Okay, and if we can get on the right side of the market, if we can follow the people that are actually making money, then we already put ourselves in the position where we can also make money as well. Okay, so we give ourselves a much higher probability of actually seeing some form of success from trading. Okay, now again, you may be wondering, okay, well, how do we do this? So there's a few sort of signs, there's a few things that we can use in order to try and identify and try and find out where these big institutions are actually trading from. I've just done a little diagram here. So what are we looking for? Essentially, what we're looking for in the markets is a big, sharp increase or an increase in volume. Okay, so where we see these big, sharp movements happening. Okay, now a sharp increase in volume, okay, a big, sharp movement shows activity from the institutions. As in order for the markets to move this way, there needs to be a huge amount of orders executed into the markets. Okay, so you have the institutions, you have the banks. When they execute orders, they're not just trading £10 or £100 or £100,000. They're executing trades of hundreds of millions, if not billions of pounds at a time. And with such large quantities of orders being executed into the market, it has an impact on the market's value. Okay, so this is where we see those sharp moves happening. Because the institutions largely control the markets, so we can trade in line with them, then we're going to give ourselves a much higher chance of being on the right side of the markets. Okay, so the main thing that we're really looking for is these big sharp moves in the markets. Okay, an increase in volume is what we would call it. So how would we trade this? Okay, how is this valuable to us? Now, what we can essentially theorize from this movement is when we see a sharp move like this, it's likely that there will be leftover orders resting where the move began. Okay, now what happens is when the market executes all of these orders, in order for these orders to actually go through, there has to be enough liquidity in the markets for all of those orders to be triggered. Okay, now what happens is, because they're such large orders, there's very rarely enough liquidity for all of them to be executed at one time. So what will happen is, for example, we'll see all of the orders get put into the market here, and we see a big push. We see a big push in price. Okay, so the price rallies up really, really hard. Now, yes, some of those orders have been executed, and they have been successfully executed, but where there wasn't enough liquidity, or where there's not likely to be enough liquidity, this essentially leads us to believe that on the return to these levels, there's likely to be a similar move occurring from this level as we come down and re-execute those leftover orders. Okay, so when the big institutions, they'll say, okay, well, I want to buy 100 million worth of GBP USD. In this case, I want to make a 100 million execution in GBP USD. And they put that market to order. They put that order to market, sorry. Okay, and we see a big sharp move in the price. Now, the market's moved nicely, but not all of those orders have actually been executed from that price. So what they want to do, they want to bring the price back down to this level so they can execute those orders at that price again. And then we're likely to see another move away from that level. Okay. So again, just to recap, what we can essentially theorize from this is when we see a sharp move like this occur, this is likely that there will be leftover orders resting where that move began. This leads us to believe that on the return to those levels, we're likely to see a similar move occur. Okay, so we look for those sharp moves. We then look for the market to return back to where those sharp moves occurred from, okay, where those sharp moves started from. That's then where we're looking to trade, because we're expecting a similar move to that initial push to start from. Okay, so for example here, we see the market, there's obviously a big execution from the institutions. They've taken a big buy order, they've driven the price to the upside. All we then have to do is we wait for the market to come back down into what we would call our demand zone. Okay, so you've probably heard me talking about this before, but we trade supply and demand. Okay, so in this case here, the market has come back down towards this demand zone. We've triggered those leftover orders, and then we're likely to see a very, very similar move to that first impulse happen again. Okay, and the same happens on the other side of the market. So the market gets to this level here, the institutions or whoever, they execute a big sell order. Okay, we see a big push to the downside. The problem is there wasn't enough liquidity for us to execute all of those orders at once. So the market then wants to return the price back to that level, execute those leftover orders. Okay, because if they want to execute, for example, 100 million worth of a transaction, okay, but there's only 75 million worth of liquidity in the markets, there's going to be 25 million worth of orders left in this level here, and they're not just going to want to leave those orders left there. They're not just going to leave those orders. What they want to do is they want to drive the price back up, execute those leftover 25 million worth of sell orders, and then because they've executed another very, very large transaction in the market, we see another push very, very similar to the first one. Okay, everyone are on the same page. Everyone understand where I'm talking from. Everyone sort of understand the angle that I'm taking here. Again, if you don't understand anything, just let me know, and we can go over it again. But again, just to recap here, if the market pushes to the upside like this, if we see a push up, the base of this zone would be called a demand zone. Okay, so if the market is moving up, we'll be trading a demand zone. If the market moves down, we'll be trading a supply zone. Okay, so demand is when the market goes up, supply is when the market goes down. Okay, really, really, really simple. Again, I'll just wait for a few, make sure everybody's confirmed that they're all happy. There's a bit of a delay, so I'll wait just to see if we get anything through. So again, it's a very, very simple concept. Again, so many people don't understand this concept, and that's why so many people lose money, because they're not trading with the money. Okay, they're trading the retail methods. Okay, and the problem is the reason that the retail traders are losing is because what they're doing is them losing provides liquidity for the institutions to execute their orders. Okay, so we're going to go into some live examples of how these trades have played out in just a second. But the reason why retail traders lose is because they're put in that position to provide liquidity for the institutions to actually make money. Okay, so the people losing are what allow the retail traders, or allow the institutions, to execute these big orders. Okay, so we've got two options. We can either trade like the masses and lose money, or we can trade like the institutions, or we can trade alongside the institutions in line with the way that they're moving the markets, and we can make money. Okay, if you've ever traded before, it's almost like relearning how to trade all over again, because this style of trading is pretty much the exact opposite to how most people teach. Okay, but again, that's what sets us apart from 99% of other people that are educating in trading. Okay, because we put you on the right side of the market. We don't put you where you're already set to lose. So let's have a look at some live examples. And again, this is GBP USD. I've been through and found a few little options, a few little trades. So let's run through them. And so what can we see here? Okay, what can we see here? So let's walk through. Okay, remember, what are we looking for? We're looking for a sharp increase in price. Okay, a big sharp move in price. Okay, and the first one that I can spot here is this level here. Okay, so what you can see is the market moved to the downside. Okay, we were in this bearish trend. We then pushed to the downside here, and then we had a big strong surge in price to the upside. Okay, a big push. Okay, now the only reason the market would ever be able to move like this is because the institutions have executed large amounts of buy orders and driven the price up. Okay, the market doesn't move like this just randomly. Okay, the market will only move like this when there's been large amounts of orders put into the market. Okay, now by seeing a move like this, we are left essentially a footprint of where the institutions have looked to trade from before. Okay, so all we then do is we just find that demand zone, okay, because the market's pushed to the upside. So where did that move initiate from? Well, we can see this was the last candle here before that big push. So we can just mark out that last candle there. This would then be our demand zone. So then what we can essentially say is, well, when the market comes back down to this level, we can expect the leftover orders to be triggered in the market, and we can expect another move in a similar direction. Okay, and what can we see happen? The market pushes to the upside, we make our way back down. As soon as we tap into that same zone, we see an almost immediate reaction to the upside. Okay, so how would I be looking to trade this? Well, very, very simple. We have this marked out as our zone here. So what I'd do is I'd be looking to buy as the market hits this level here. Okay, so this is called a buy position tool. This is just to demonstrate where I'll be looking to trade. So I'll be looking to buy as the market hits the edge of the zone. I'll then put my stop loss at the bottom of the zone, just like that. Okay, and then I'd be putting my take profit where that move ended. Okay, in this instance, where that move ended. Okay, so we saw that big push to the upside, and then the market pulled back here again. And we saw a bit of a trade on the opposite side. Okay, we saw a big push to the downside. Okay, so we saw that the market ended here. So what I'm going to do is I'm going to put my target where that move ended. Okay, and what can we see happen here? We came back, we tapped into that zone, and what happened? We went straight to our target. Okay, we went straight up and we hit our take profit. So let's walk through this trade and sort of how we would angle it. So a few key things to take away here. I'm looking to enter the trade here, and I'm looking to put my stop loss here. Okay. Now what this tool here does, if I go to this tab here on the left hand side, and then I press the little arrow to the outside, we'll be able to use, in this instance, because we would have been looking for a buy trade, we use our long position tool. Okay, this essentially just allows us to mock up where we're going to be looking to trade. Okay, this gives us essentially the stats of what our trade would be doing. Okay, so we can use that long position tool. It will pop up something very, very similar to this. Okay, so what we can say is this line here is where we're looking to buy from. This is essentially where we're going to be putting our stop loss. Okay, and if you look at these stats here, if you look at the number where I'm hovering over just now, it says 8.8 just there. Okay, now what this represents is, this is the size of our stop loss. Okay, so this is 8.8 pips. Okay, so 8.8 pips. When we're going to use our risk management calculator, this is the number that we'd be putting in for our stop loss size. Okay, everyone with me on that one? So we'd use this tool to figure out how big our stop loss is, and we then use that number to go and calculate. So we know what lot size to use when we go and enter the trade on MetaTrader. So we can only risk, so we risk 1% on this trade. Okay. So again, you don't need to go in get sort of too technical yet. We'll be able to walk through the process at a later date. But the key thing to take away here is, all we really need to know before executing this trade is, we're going to put on our stop loss here, we're going to be entering the market here, and how big is our stop loss? That's 8.8 pips. So we put that into our risk management calculator. We'd know what lot size to use. So when it's time to enter this trade, we know exactly what lot size to use. So if the trade doesn't go our way, okay, so for example, we might not have seen this reaction here. Okay, not every single trade runs and does exactly what we're expecting it to. If the trade ended up just coming straight down here and taking out our stop loss, because our stop loss was just here, we know that worst case scenario, that trade would just lose us 1%. Okay, so if this trade went bad, we'd just lose 1%. Now then, so I touched briefly on risk to reward. Okay, if we're losing 1%, we don't want to just be making 1% back. Okay, we want to be using a positive risk to reward so that we can put the odds in our favor. Okay, so we can put the odds in our favor so that we can lose more trades than we win and we can still make money. So for example, in this trade here, again, just outlining, we can see that our stop loss the size of our stop loss is very, very small, and the amount we potentially look to gain is much larger. Now this is because we've got a risk to reward of 5.35. Okay, 5.35. Okay, so this essentially means that we're risking 1% and we're looking to gain 5.34%. Okay, so what happened was the trade got executed, we entered that trade, we then went on to hit our take profit, and when we hit our take profit, the broker essentially closed our trade for us, and we came away with 5% gain. Okay, so we risked 1% and we came out with just over 5%. Okay, and that's called a positive risk to reward. Okay, so again, just to keep things nice and simple here. What did we see? We saw the market moving to the downside. We then saw a big increase in volume. Okay, we saw a big push to the upside. Okay, we then just backtrack. We backtrack. Where did this move start from? Well, we can see this was the last candle here before the big push. So we can mark this candle off. Okay, so we can use the rectangle tool. Okay, so if we go to this one here, we can use the rectangle tool here, and all we have to do is, I'll use that again. So again, we can use the rectangle tool. We then just mark off that last candle like this. Okay, so then as the market comes back down, we know that this is where we want to be entering. So as the market taps into this region here, we just look to buy. Stop loss just below. We then target where the move ended. And we can see there, we tapped that level and we ran off and we hit our target. So yeah, so Bobby has said, so if you risk £100 at 1%, your profit would be £500. Okay, so if say for example we risk 1% and that 1% equates to £100. Okay, we've got a £10,000 account, so that 1% is worth £100. Okay, so what we're doing is we're essentially entering this trade saying, okay, I'm happy in this instance to risk £100 to potentially gain £500. Okay, because our risk to reward is 1 to 5. Okay, so we can use this tool here again just to calculate what our risk to reward would be. So we've analysed this trade and we can say, okay, well, on this position, if we look to if we're looking to lose 1%, which equates to £100, because our risk to reward is 1 to 5, we're looking to gain £500. Okay, so we're risking £100 and we're looking to gain £500. Okay, so you can see if over 10 trades, you on your wins you're gaining £500, on your losses you're losing £100. You can see how your average there would stack up and you'd be very, very profitable. Okay, and you can actually end up losing more trades than you win, and you'll still end up coming out on top because your wins are much more valuable than your losses. Okay, so Ben has said, are we looking for confirmation candles or just when it comes down into our zone? So yeah, in this instance, you don't have to be looking for candle confirmations. You don't have to be looking for candlestick confirmations. Okay, you can just trade straight off of these zones. Okay, because of the theory that behind the way that we're trading. Okay, because we're saying, well, okay, well, if the market pushed away like this once, when we come back to it, because of why it's done this, there's a high chance that we're going to tap that zone and we're going to see that those orders being executed and we're going to see a similar move. Okay, so there is ways of looking for further confirmation, but again, I'm not going to get into that in this session. Again, we'll get a bit too technical. But because of the theory behind why these zones are significant, we don't necessarily have to look for that candlestick confirmation, because we know that there's going to be leftover orders sat in this level here for us to execute and then begin that move again. Okay. And again, just to take another step here, we've also got another level potentially, or another level that we could have traded from here. Okay, so we had this big push to the upside, and then what did we see? We saw another big push to the downside. Okay, we saw another big push here. Okay, and again, if we look at this, yes, we saw a big push to the upside, but the only reason the market's going to push to the downside like this is because the institutions have executed a large amount of sell orders. Okay, so we've had a big push to the downside. What does that create? That creates a supply zone for us to come and trade from. Okay, so again, we saw this level being tapped here. We then saw the market come back up to where that zone ended, into a supply zone. And what does this do? This quite simply gives us another opportunity to be trading back down. Okay, so again, in this position here, we could have looked to sell there, stop loss just above the high of this level here. Where did this push end? Down in this level here. Okay, we've got this demand zone here. So again, we can just look to trade very similarly like this. And then again, we've got another trade. This time we risked 1% and we're looking to gain 7%. Okay, so we risk £100 and we're looking to gain £700. Okay, just for argument's sake. And what happened was we tapped into that zone. We reacted because there's leftover orders at this level. And what did we see? We saw a big push to the downside and then the market ended up going and hitting our target again. So just from this very simple piece of movement here, okay, this was all in all, let me see how long this was. So from this level being created here to this level being tapped into here, this is 1 day and 11 hours. Okay, in 1 day and 11 hours, we've had a 5% win and a 7% win. Okay, so again, if we were looking at risking £100 on each of these trades, we've made £500, we've made £700. Okay, so we've made £1,200 profit in 1 day and 11 hours, just from these two trades. Okay, now this works on every single time frame, but the one that I'm using here is a 15-minute time frame. Okay, that's going to be one of the main time frames that you'll be using. Okay, in our full strategy, again, I'm not going to get into it this evening because it get a bit too technical and it's a lot to learn. But we use multiple different time frames. But again, just for argument's sake and just to keep things nice and simple, 15-minute time frame is one that you should be focusing on. Okay, so let's have a look at some more examples, and I've marked off a few ones here. So again, let's look at this level here. Let's look at this piece of price action. So let's work from left to right. Okay, where can we see big sharp moves occurring from? Okay, where can we see big sharp moves occurring from? Well, we can obviously see there was a big drop here. The only reason these types of drops happen is when we have large amounts of orders being executed into the market. Okay, so what we can do is we can theorize that when we return to this level, we're likely to see a similar move happen. Okay, and what happens? Again, it takes us a while. It takes us just over a day or two. But as soon as we come and tap into this region, what happens? We tap and we push back to the downside and we see a very similar move occur. We see another sharp drop. So how would we look to trade this? Well, exact same system as we used before. We enter at the edge of the zone. Okay, you can see how I've marked out the last candle before the big drop. Okay, and that's what I've marked the zone from. The last candle before the drop. So we'd enter from the bottom of the zone. We'd put our stop loss just above. Stop loss just above the zone. And then we can target, in this instance, we're actually targeting a new demand that was formed. Okay, we'll touch on why in just a second. But the market tapped that level, went straight to our target. We've risked 1% and we've gained 6%. Okay, so we risk £100, for example, we gain £600 if it hits our target. Okay, so again, we've looked at 3 trades now. We've had a 5% win. Okay, we've had a 7% win, and we've now had a 6% win. Okay, so even if we were to lose 10 trades in a row, from this point, we would still be in profit. Because we're using a positive risk to reward. Because every trade that we enter, we have a much higher potential of earning money than we do of losing. Okay, everyone with me on that? So that's one trade. Now again, let's work back this way. Okay, where else can we see big sharp moves? Well, we've got a big sharp move there. We can see a big sharp move there. Again, this one is slightly unclear because the price action, okay, the candles before the big sharp move, they weren't very clear. Okay, there was a lot of mess in this area here. So this was probably one that I wouldn't be taking because the market isn't really showing us a very clean level. Okay, we want to be looking for levels that are nice and easy to understand, nice and clean. Okay, because it's quite choppy here, there's not really a lot to go off. Okay, so I'd have probably left that one. Okay, we did see a sharp move, but probably not a level that I'll be looking to trade. The market keeps moving, the market keeps moving. We've somewhat of a sharp move, but again, not super significant. We didn't really have much follow through from these levels. Okay, so not really ones that I'm super keen on trading. Maybe in the lower time frames we would have seen something, but on the 15-minute, there was nothing. So we have this one here. What did we see? We saw the market push to the downside, and then we saw a big sharp move to the upside. Okay, a big, nice rally from this level. Okay, now what does this do? All we have to then do is we mark the area, the demand before that big move. Now, what we can see here is this one sort of pushed and then rallied very, very quickly. So there wasn't really too much of a sort of base that formed here. So what I've done is I've marked that whole sort of pivot move there. Okay, that whole pivot move, and I've used that as that demand zone. Okay, the market pushed to the upside. We did come back slightly, but we didn't quite tap into this level yet. We didn't quite touch that level. We can see here we got very, very close, but we didn't quite touch that level. Okay, so we didn't quite have a trade there. Okay, didn't quite get executed just yet. Now, I could go in and sort of explain why this was a good thing, but again, it would be getting slightly too technical, but this is a very, very good sign. And this is one of the reasons why when we do come back, we see such a big move. But again, that's something that we cover in the full course. Again, getting a little bit more technical, but again, we didn't quite touch this level. We didn't quite touch this level just yet. The market pushed up. That's where we tapped into this supply zone, but then we had that push and we tapped into this level. Okay, so again, we've now had our order essentially executed from this level. Okay, so we come into this region, and what can we do? We come into the edge of the zone. Stop loss just below. And then we can essentially go and target, because we've been creating a number of highs here, we can just go and target these highs. We can target where this supply is. Okay, so we just trade very simply back into this region here. And in this case, again, we risked 1% and we gained 5.48%. Okay, so we risked £100, and in this instance, we made just over £500 profit. Okay. So when the market pushes to the upside, when we see a big push to the upside, when we return to this level, we're going to expect the same thing to happen. Okay, so if we've seen a big push to the upside from the zone, when we return to it, we're going to expect another push to the upside. If we've seen a big push to the downside, when we return to it, we're going to expect another push to the downside. Okay, so when we tap back into this level, that's where we're going to be looking to sell. If we tap back into this zone, we're going to be looking to buy. Okay, so if the market moves down from the zone, we're going to be looking to trade down again. If the market moves up from the zone, we're going to be looking to buy and looking to be trading up from that zone as well. Okay, Lewis, do you take overall structure into consideration? Yes, of course. Again, just to keep the session nice and easy for everybody, and just to have a very sort of overall look at the system, we're going to be looking just at the 15-minute time frame, just to get that concept ingrained into our head. But when we're looking at the full trade plan and the full system, you'd use the higher time frames as well to build a more sort of higher probability overall narrative of the higher time frames. Again, you'd want to be trading with the flow of the market. I use the 4-hour and 15-minute time frames to find my supply and demand zones, then I'll use my 1-minute time frame to execute my trade. So yeah, that's typically how we would teach in the course. But again, just to keep things nice and simple for everyone today, if you're trading it in the most simple way possible, you'd be looking to trade from these 15-minute zones. is 3 touches to the demand solid confirmation? It's not so much on the touches. Okay, if we're seeing multiple touches of the zone, okay, so for example, if we see a tap, a tap, a tap, and we're not seeing a reaction, what that tells us is that the orders that were left over here, there's not that many orders there left over, and these taps here have just absorbed all of those orders. So what this tells us is that the zone is likely to get broken. Okay, so if we don't see a reaction from the zone, it essentially means that there's not leftover orders, and what we thought was going to happen is not likely to happen. Okay, so we typically want to be seeing as the market pushes and we see that reaction almost straight away. Okay, if we saw a tap there, it pulled back a little bit and then another tap, then it's just telltale signs that the market's just going to end up breaking through that level. Okay, but again, I don't want to get too technical. I just want to keep things nice and simple. Okay, so again, it's a very, very simple concept, and all we're really looking for is where is the volume in the markets. Okay, where are the big institutions buying or selling? The telltale sign is, where are we seeing these sharp moves? Okay, where are we seeing these sharp moves from? Okay, we see sharp moves all the time. The institutions are buying and selling constantly. Okay, so there's opportunity using the system all the time. Appreciate the kind words, Kieran. So again, let's just touch on another example here that I've spotted. So what can we see happening here? Okay, my computer's getting a bit slow. But what can we see happening here? We can see the market pushes to the downside. We've then obviously got to a price where the big institutions are happy buying from, and we've seen a big push to the upside. Okay. We know that when we return to this level, that we're likely to see a very, very similar move to the one that initially created that footprint. Okay, it then took a bit of time, but we didn't come and tap that level just yet. But when we did eventually come and tap this region, what happened? We tapped and we rocketed off once again. Okay, so let's have a look at the risk to reward on this one. Okay, we'd look to enter there. We'd have our stop loss just below the zone. Again, we'd be looking to target somewhere up in this region. So for this example, the market spiked here, and on this one, we risked 1%, and we were looking to gain just over 8%. So if we were to have risked £100, we'd have come back with £800 profit. Okay. Now the positives of this system is the fact that every single trade we enter, we have a very good risk to reward. So if you're a beginner and you learn this system, you can afford to take losses, granted you manage your risk correctly. Okay, is everybody with me on this? Everybody understand the system? And again, if you go back and you'll be able to look through the charts for yourself, you'll be able to find a ton of these opportunities and a ton of these moves actually playing out. This is essentially what I'm looking for time and time again, every single day. Okay, again, what can we see here? A big push to the downside, changing the direction of the market. So we had a slow move to the upside. We reached this price and we saw a big push to the downside. What happens? The market eventually comes back to tap this zone. We tap into that zone, and what happens? We move to the downside again. There's a bit of delay in the thing, but right, I'm assuming that everybody's happy anyway. There's a delay in the chat, but if you have any questions, of course, I'll be able to answer through the rest of the thing. But let's jump back into the lesson. So mind blowing. I'll be watching all of this again and again, as well as getting into the Kickstarter. Fantastic. Sounds very, very good. So 4 things you need to master to become a successful trader. We've looked at building the armory. So you know exactly what tools, systems, platforms, and everything you need in order to actually trade from. Number 2, you know how to protect your money. You know how to keep that risk low. Number 3, you know the system, you know the approach that we're using in the markets to find winning trades time and time again. So number 4, you need to be able to take action and apply the process. Okay, you need to build that winner's routine. So let's have another little touch on it. Again, we touched on it briefly yesterday on the sort of system and how I usually approach the days. But let's just have a little look again. So how do we build a winner's routine? So first and foremost, the thing we need to understand is, let me just get rid of my camera because you won't be able to see what's in the bottom. So the first thing we have to remember is we trade for freedom. Okay, we could sit and trade all day and all night if you wanted to, and there'd be tons of different opportunities. Okay, but we trade for freedom. So we want to be able to build a routine that allows us to plan our attack, get our trading done in a few hours so we can unlock that freedom and we can spend the rest of the day doing what we love and doing essentially what we want to be doing with our lives. So a winning routine consists of 3 things. When will I be doing my pre-market analysis to prepare myself for trading? When will I start trading and when will I end trading? Okay, and then you need to be regimented with that routine so you can consistently repeat the process that will ultimately allow you to generate profits from the market and unlock that freedom that trading can unlock if you get it right. So this is my routine, okay, just in a bit of a nutshell. Okay, so I will typically, I'll do my pre-market analysis at some point during the weekend. Sometimes I get it done Saturday morning, sometimes it's Sunday evening. Again, it doesn't really matter. Markets are closed on the weekend. Okay, so you can pick any time during that weekend to get that done. But it's very, very important you sort of prep yourself and give yourself a bit of an understanding where the markets are before they open. Okay, they're open at 10 o'clock on a Sunday, but we don't start trading until Monday. So I'll typically start trading and do a bit of pre-market analysis around 7 a.m. Again, it's more so about 6:30 now because I like being up early. Getting prepped for the start of the London session at 8 o'clock. Okay, now this is because I actively trade the London session. Okay, if you are, for example, like Grant has put a question in the comment section, if you're trading around your job, we have a system that allows you to do so. So instead of you actually physically trading the London session, okay, instead of physically actually trading the London session, you can, instead of actually placing the trades yourself, you can actually set orders. Okay, so similar to what we've done, in today's lessons where we found the levels. Instead of you actually physically entering the trades when they hit the zones, you can set orders. So when the market returns to those zones, you'll automatically be entered into the trade and you won't have to do anything else. Okay, so we've actually built a system that allows people that do have a 9 to 5 and they haven't got quite as much time to do their pre-market analysis, whether that be 4 o'clock in the morning, 5 o'clock in the morning, before they get to work. You're able to get up in the morning, do their pre-market analysis, or before the London session starts. They're able to set their orders and get on with their day. Okay, now the downside of this is because you have to give the trader slightly more breathing room because you're not actually there able to trade, your risk to reward isn't as good. Okay, so you'll be going for perhaps 1 to 4s, 1 to 5s, 1 to 6s. But if you're able to actually trade and you're able to use our lower time frame entry models, we're able to extend that risk to reward to sort of 1 to 10s, 1 to 12s, and so on and so forth. But if you've got commitments, there is ways of you building a routine and building a system that allows you to get your trading done and prepared before you go to work. Okay, and my routine typically finish trading around 10 a.m. Of course, this is contingent. I mean, yesterday this morning I was up. I'd done my trading and I'd finished it by 8:30 because the markets moved quite nicely. I got in, entered my position, got out with some profit. I took about 11% this morning, and then I got on with my day and done whatever I wanted to do. Okay, so some days you're going to be sitting there till 10 a.m, maybe even 11 a.m. in some cases, and you might not have a trade. But some days you're going to get in, it's going to be half an hour, and you're going to be done. So again, this is a little bit of sort of how my routine will typically look like. So I'll wake up, prep for the day, 6:30, 7 o'clock in the morning. Again, if you're going to work at 6:37, you can do so before this. Before the London session, we don't see much movement really. We see the movement sort of starting to happen at about 7:30, 8 o'clock. So as long as it's before that you've done your pre-market analysis, you're all good to go. And then during that morning trading session, that's where we're typically going to be looking to enter the trades. And it's by being regimented with this trading routine, or with my trading routine, that I free up the rest of my days to do the things I love. Okay, so I'm able to get into the markets, use the system to find the trades in the morning, trade that London session, get my trading done by about 10 o'clock, and then I've got the rest of the day to get on with whatever I want to do. Do all the sessions slow down for a couple of hours after they open? Asking as US trader, is any session better than other as far as volume? So London session and New York session are the two sessions that we trade. London session, it depends where you are in America, it can be some pretty crazy times. But again, if you're up and you can trade the New York session, then fantastic. The New York session is perfectly good to trade. Edgar has said, are all your trades with 100 times leverage? So leverage doesn't really make any difference to the amount that you make or the amount that you lose. Okay, if you're managing risk and you're managing risk to 1%, leverage doesn't really make any difference at all. Okay, leverage doesn't mean that it's 100 times the amount that you're risking. Okay, leverage just gives you, it essentially gives you more breathing room in the trades. Okay, so you're able to hold more positions, but it doesn't physically change the amount that you win or lose on your trades. Okay then guys, so what have we touched on today? Number one, building your armory. Okay, so you know all the tools, you know the systems that you need to be using to actually become a successful trader. Number two, you know how to protect your money, the most important lesson. Okay. Number three, you know how to find your trades. Okay, you know the approach that we're going to be using to find trades. Okay, and number four, you know how to build a routine to actually win in the markets. Okay, so you know when to be looking at the markets. Okay. So we have now essentially assembled that battleship. You have now got the tools and the systems that you need to go away, find trades in the market and make money. Okay, so I've got a few action steps for you. You've now got tomorrow's trading session, and then you've got time over the weekend where you can go and look whilst the markets are not moving. But what I want you to do is, I want you to find a trade on TradingView. I want you to find the trade, so you plan the stop loss, you plan where you're looking to enter, and you plan where you're looking to exit. Again, this could be a trade that's already happened. I just want you to be able to identify it. I then want you to manage your risk to 1%. Okay, so find the lot size that you'd need to be using based on your account balance and stuff like that, using the risk management app. And then again, if you do the trade tomorrow, I want you to execute that trade using MetaTrader 5. Now, this isn't about making money. This isn't about making money. This is about going through the process. Okay, getting comfortable with the process. Okay, so this is a few action steps to take away. Something to look at tomorrow, to look at on Monday morning as well, and to look at over the weekend. Okay. Now, again, you can let me know how you get on with this in many ways. You can message me on Instagram. That's probably the best place. That's probably the only place really. So yeah, message me on Instagram, send me over, or you can email me, or have my email. You can send me an email, but just go through the process. Okay, go through that process. Okay, get yourself comfortable, because in next week's lesson, we're going to be looking at the cheat code to 10K per month with your trading. Okay, we're going to actually look at a system that we have put together and a system that has been developed within the industry of how you can actually use the tools and the systems that we've just had a look at to generate 10K per month with your trading in a way easier way than you may think. Okay, without having to invest tens of thousands of pounds of your own money. Okay, the reason I call it a cheat code is because it's quite literally changed the game. Okay, this system that we're going to be looking at next week, I have been seeing thousands and thousands of people make hundreds of thousands of pounds using this very system. This cheat code is really what has led to the huge influx of success in this industry in recent times. So again, guys, fantastic session. This will be available to watch back, I think, pretty much instantly anyway. So you'll just have to go back in the video library that you got emailed this morning, and you'll be able to watch this lesson back. Again, any questions you have, you can message me on Telegram. I'll put my @ in the Telegram channel. You can message me on Instagram, but the next lesson will be on Monday. Okay, Monday at 7 PM, and we'll be looking at the cheat code to 10K per month with your trading. So again, this one's been quite heavy. We've been going for about an hour and a half now. You've got a lot of stuff to take away and execute into the markets and get comfortable with. But again, it's been an absolute pleasure. Remember, I'm giving away a pair of AirPods this time tomorrow. So if you haven't taken a picture and shared it on your Instagram, take a quick picture now so you can share on your Instagram afterwards. Make sure you tag me and make sure you tag WeTrade. But again, guys, it's been an absolute pleasure. I've thoroughly enjoyed this. And I will be speaking to you all at 7 PM on Monday. Again, any questions, don't hesitate to let me know. But I'll speak to you all very, very soon. Cheers, guys.